What's up, everybody? Michael Silva here. This is a chart of the S&P 500, and we are going to talk about how to properly prepare for the stock market to bounce in today's stock market brief show. We have a lot also to discuss. I'm going to give you the case as to why we can potentially see a bounce, some indicators that I'm looking at. I'm going to show you the zones and also the weekly expected moves for multiple products. Now, we already know the bears stepped in big time. We prepared for that. You can see here, week to date, all red down the board. That takes a lot away from that year-to-date gains, but we'll see here if this is just a temporary pullback or not. Many people might be wondering, well, what's going on right now? Well, this could be the market just pricing in the change in the federal funds rate, at least the meeting probabilities. See here in March, we now have a 73% chance. Now this is growing to a 27% chance of a 50 basis hike. So it looks like this. The main probability goes in March, we raise 25. In May, we raise another 25. And then June, we raise another 25, bringing us to around 525 basis points, or 5.25% to 5.5%. Now, we've already talked about that in a few episodes ago, where this all of a sudden changed out of nowhere and the market was up on the day. It was very strange. But what I find different now taking place is we've seen stronger probabilities of potentially a 50 basis point hike there in March, there in May, and even, well, through the rest of the year. But what I also notice here is you can see that the market might be just pricing out currently the Fed pivot, because you can see we raise, we raise, we raise, we hold. So that's the pause. On the other prior episodes, we talked about how it was starting to drop there in November and December by 25 basis points, which would be that pivot. So it could be that the Fed's continuing to tighten. So nothing there from that narrative change. It could also be the macro data drop that came out, right? The Fed's preferred inflation gauge accelerated, adding pressure for more rate hikes, and you can see that there on the screen. Now, if that's the case, we do have a lot more macro data drops coming out next week. Starting on Monday, we have a major report right here, durable goods, and you can see pending homes, and we have also Fed speak. On Wednesday, March 1st, the beginning of the month, 7 a.m., that's Pacific Standard Time, so 10 a.m. Eastern Standard Time would be ISM Manufacturing PMI. And then also on Friday, we have the ISM Non-Manufacturing PMI. So yeah, what's the case for the bounce here? Well, right here, this we've been kind of termed the golden zone, or if you look at Fibonacci sequences, I believe that it's called the golden zone. I'm just calling it the golden zone if it's not. No, I believe it's called the golden zone. And basically what that is, it's the 50% retracement level to the 61.8% retracement level. And I'm measuring it from this low to this high, and that's where it pulls into. That's what we've been preparing for way back up here, and we pulled back into it on Friday's trading session. We actually pulled into it on Thursday. We saw a bounce. I wasn't able to make a video that specific day because I'm moving. Now I'm back in my studio. Hallelujah. And now we're back here after that macro data drop. Now, it's not only the fib retracement. There's a lot of things going on here that are in confluence for support. And I'm not going to point out all of them. There's even one if I zoom out further, but we're at the lower level of this trend, right? We're at the 200 SMA. And we're right here in this fib sequence, okay? So there's a lot of support up in this area. So the bears either have to continue to just break this down very hard and aggressive, or the bulls are going to step in and potentially see the relief of a bounce, which may be the case, as I'll point out many different indicators that are becoming oversold in the near term. But there's a way to properly play this, okay? So if I show you this is the 15-minute chart. I like to look at this. So when you see price coming into an area of support, of confluence, you like to get into the smaller time frame charts to see here, okay, well, what do we need to look for? Well, this looks like crud so far, right? It could be flagging right here. This could break down to the lower weekly expected move for the S&P 500, which is the SPY at 388.74. We have an area of support right over here at 393.46. So that'd be one key level to watch. If it's broken, that opens the door to head down lower. So how do you properly prepare for this? Well, understand this. We are below a declining 5-day moving average. All right, a declining 5-day moving average. We're below a year-to-date anchored VWAP right here too as well. So if price starts to move up, yeah, right. Are you going to chase it right into here? I mean, you might get lucky and it could come up to the upper weekly expected move, but understand that this is a lot of pressure that could potentially start coiling down. So what you want to see is the 5-day moving average to start flattening out and going neutral, and you want to see price get back above it like so, and then this starts to follow like this. You want the year-to-date anchored VWAP to start turning back up there too as well, and that would be a lot more positive for the overall bulls. So yeah, things could be overextended where we see a potential bounce. But remember, if this is still declining and pulling down, if this is still going to be declining and pulling down, you need to not just trust this blindly, because it can get pulled right back down very fast, as we've seen in some very aggressive volatile price action. If I zoom out further on the 15-minute time frame, I will point out price action has been going lower, but the indicators here like price momentum oscillator and even the RSI are putting in positive divergences. So if we do start breaking to the upside, understand that a move up to the upper weekly expected move is very well possible, but you need to be hesitant also when it gets up into that area. So it's all about being aggressive and taking profits. Now, why could it potentially bounce? I'm looking at a couple of things here. This is smart money up here, the bond market. This is dumb money down here, the SPY traders, right? So we have, this is just a quick term. It's not to offend anybody. Oh gosh. So the smart money over here is bonds. Equities is the dumb money. And sometimes when you see a divergence between smart money and dumb money, it gives you a heads up notice. Okay. So I'm not going to go through the prior examples of when that happened. If you've been here, you've known, but I'll show you what it looks like. Right here on HYG, we have a low and a higher low. Okay. Now this could be flagging. This could break down, but that's as it stands. What's going on? Bunch of emojis. I just emoji bombed you. Okay. And then we have the SPY, a low and a lower low right here. So as it stands right now, the smart money actually put in a higher low on these shorter time frames, and the dumb money put in a lower low. So is smart money telling us, hey, we actually might see SPY bounce here in the near term? Doesn't mean that the whole trend is going to change back up to bullish, but is this giving us an indication? Well, we will find out, right? You can see it in hindsight later. But this is an area where I'd be like, okay, yeah, I'm going to start shorting right here. That's not necessarily the move I would personally make. But let's continue on. BP SPX chart, it is getting oversold conditions, the RSI down there. Okay, energy sector, so another big one to be paying attention to. It's in that oversold condition there. Financials, another big one that can really pull this market down. It's not oversold yet, but it's not too far off. You have discretionary, another sector. It is in oversold conditions. So think of like Tesla, think of Home Depot, right? A lot of those bigger names in the discretionary section, they've been pulling back. And now in the BP charts, we are getting to that oversold condition. BP INFO, not quite oversold yet. However, the NASDAQ, and if you don't know what INFO, that's technology sector. NASDAQ 100, however, is. Okay, so we have a lot of indicators from this sell-off moving into oversold conditions, and we have this whole level of confluence of support. So how to properly prepare. Yeah, we might get the bounce, but understand that the trend here in the short term is down. So everything that stays below a descending 5-day moving average right there, and also this year-to-date anchored view up that's floating, you just need to be, cautiously bullish if we see that rally, right? So you always got to be a little cautious with that. Now, a couple other things that I want to call out here. S&P 500 is at the lower range of the zone. As you can see, we're getting a green reading. So if I look at the low right here, it's currently at 39.33 and we close at 39.70. So this is what it looks like going into the next trading week. These are dynamic. They're always changing, but it's a really good tool to help visualize quickly of what sectors might be overbought and oversold based on a specific indicator here. And then we have also to note is the dollar. The dollar is firing off bright red, which shows us right here. So if you see the high, it's at 105.4. The close was at 105.26, which means we have 0.13% upside on the current loaded zones, and then up to 2% downside if you're thinking of this as like kind of like a Bollinger Band or a band, right? Price would be, right here where the lower range would be down there, okay? And we're seeing also obviously a lot of green. So as the dollar really ripped higher, well, guess what? Everything's sold off. That's something that we've been seeing for a while. And you can see here, the dollar started breaking through this little level over here. It's back up to around that 105. It's getting, to this prior area over here, which could act as a potential level of resistance. The RSI is moving into that overbought condition. And as this was moving up, look at what the S&P 500 was doing. It was kind of coming off. Not to only mention that, the 10-year yield has been on this rapid run up. Okay, a lot of yields have been moving up higher, right? And that's putting pressure on growth stocks. So the 10-year yield is at now 3.95%. So a big move. And if you just take a look down here, look at that yield curve between the 10 and 10 minus 2. It's at 83 basis points. So this thing continues to just get, more inverted. It's absolutely bonkers. Now, if we start to get a bounce in the markets, I also want to call out just a couple of things and potential like trade idea, something to watch from a more volatile perspective. But before we do, if you want to screenshot this, these are the weekly expected moves. So we're looking at the S&P. These are the products over here. This is the expected move for the week, and this means plus, I'll draw it out for you, plus or minus. This was the closing price of last week, and this right here is the higher expected move, and this is the lower level of the expected move, okay? So if you screenshot this, now you know what it looks like, which means what? Well, 68% of the time, price closes within these ranges. And if you're talking about the S&P 500, the SPX, it's actually more north towards 80% of the time it closes within there, okay? So the high end of this is at, for the SPX is at 40.47. The low is 3892. Now, this level right here is one that I've been really paying attention to. Not 3892, but 3900. Why? Well, because 3900 is still right here at this lower range of this channel. It's still right near that 200-day moving average, and it's right here at that 61.8% retracement level. So last week on the expected moves, we talked about, hey, watch for a potential for a 2 sigma move. Well, it was almost there. So I started looking for potentially covering some shorts and then also adding to some longs just to have exposure from the long side if we do get a bounce. All right, now, moving on, I want to go talk about Tesla really quick. Tesla, so this is the expected move for Tesla next week. It's plus or minus $17. So the reason why I'm talking about Tesla is because Tesla is one of the heavy market cap stocks in the S&P 500. So if the S&P 500 is going to rally, this would be a name that you'd want to see at a rally alongside of it, or a rally to see the S&P 500 move. Now, we talked about consumer discretionary. Where did I pull that? Consumer discretionary being over sold conditions on the BP charts, right? This falls within that category. So what to watch for here is prices pulling into that 20-day moving average. Things are getting oversold. We had a little tiny hammer candle right here. The volume, so we, on this move up, we've had some big volume, and on this pullback, you can actually see it's actually volume has been declining. So this is a low volume pullback. So if we start to see, more volume come in and this start to move up, this might have a chance to go take its upper weekly expected move, which is plus 17. Okay, so that's a pretty large move, right? Remember, it's plus or minus is the expected move, but if the market is going to bounce and we start to see, things like this 5-day moving average start to flatten out here, price to recoup that or recoup even the year-to-date anchored VWAP, yeah, I would imagine to see Tesla moving up alongside of that. That's just an opportunity potential, right? That's all I got for you here on today's episode, everybody. Hope it helped out. That's all I got for you. Have a good night.